Building wealth. It feels like it should be simple, right? Save money, maybe stick it in a bank account.
Yeah.
But the stock market, that's where the real potential seems to be. But gosh, for so many of us, it just feels huge and kind of intimidating.
Absolutely. It's often seen as, risky, overly complicated, almost like a casino where only the pros win. That
Yeah,
hesitation, completely understandable.
totally. Like it's just luck or you need some kind of insider info. But, the real insight from digging into the source material for this deep dive is that, well, anyone can actually navigate the stock market effectively.
Right.
It's not about luck. It's more about building knowledge, using proven strategies, and having patience and discipline.
That's really the core message we found.
Yeah.
Our mission today is to, peel back the layers for you, to really demystify stock market investing using the material we were given.
Okay.
We want to show you how you can participate and build wealth with a clear plan. Think of it as a guide, really, for someone looking to get started or just understand the why behind it all.
Perfect. So in this deep dive, we're going straight to those strategies that seem to work for long-term wealth growth. We'll unpack the power of buy and hold, look at how dividend investing can build income and wealth, and touch on those different ideas, growth and value investing.
Okay, let's just start by saying what's, pretty clear from history.
Mm.
The stock market has been one of the most powerful engines for building wealth over time, period.
Right.
It offers return potential that's just hard to find anywhere else, really.
But let's tackle that intimidation factor. Why does it feel so risky or complex?
Well, look, the market is volatile. Crashes do happen.
Yeah.
Headlines scream about losses. And honestly, the sheer volume of news, company reports, financial jargon, it can make your head spin.
Definitely.
It gives the impression you need to be, glued to a screen, trading constantly.
And that's exactly where our sources push back, isn't it? They make
Yeah.
it clear this isn't about timing the market or being some kind of day trader.
Exactly. The
Yeah.
focus is squarely on strategies built for, let's say, durable wealth creation, maybe even generating income, which is quite different from just speculative trading.
Mm-hmm.
The big takeaway right at the start is, with the right knowledge and patience, it's truly accessible for anyone.
All right, let's jump into that first big strategy spotlight then. Buy and hold. It sounds, simple. You buy a stock and then you just hold on to it. Is that it?
That's pretty much the essence, yeah.
Yeah.
You identify quality companies, buy their stock, and the plan is to hold those shares for years, maybe even decades.
Okay.
And the crucial part is you consciously try to ignore the short-term noise, the daily ups and downs, the quarterly reports that cause, temporary jitters.
Okay, holding for years.
Yeah.
That sounds, slow. Why do the sources say this is actually a really powerful way to go?
Well, there are a few really powerful reasons that come through in the material. First, just look at history. The stock market's long-term trend is, undeniably upward.
Right. Despite the bumps.
Exactly. Yes, there are big downturns,
Yeah.
recessions, crashes. But over decades, the market, if you look at something like the S&P 500 index, has consistently climbed higher. People often quote historical average annual returns around, say, 10% over the really long haul.
Wow.
So time is genuinely on your side because the overall tide tends to rise.
Okay, so you ride that long-term wave. What else makes this work so well?
Compounding returns. This is where the magic really happens, or at least accelerates.
Compounding, yeah.
When the companies you own reinvest their profits back into the business to grow, or maybe they pay dividends, which you then use to buy more shares, your money starts making money on itself. And those new shares, they also grow and potentially earn dividends. It creates this exponential snowball effect over time. It's highlighted again and again as key.
So if you're committing to holding for the long run, how do you actually pick the stocks? You can't just pick any company, I assume.
Oh, definitely not. No, this needs thoughtful selection. The sources really emphasize looking for companies with strong fundamentals.
Okay, strong fundamentals. What does that mean in practice?
It means digging into their financial health. You look for consistent earnings growth. Is the company reliably making more money over time? Check for low debt. A healthy balance sheet means less risk. And look at something called return on equity, or ROE.
Okay, hold on. ROE. And earlier you mentioned PE and PB. Can you just quickly break those down? For someone new, those terms can feel like that secret club language we talked about.
Great point. Yeah, let's simplify those. PE ratio, price to earnings. Think of it as the stock price divided by the company's earnings per share. It tells you how much investors are willing to pay for each dollar of profit the company makes.
Okay. High PE means high expectations.
Often, yeah, high expectations for future growth. A low PE might mean it's seen as undervalued relative to current earnings.
Got it. And PB.
PB ratio, price to book. This is the stock price divided by the company's book value per share. Book value is basically assets minus liabilities. So PB compares the market price to the company's net asset value. Is it trading above or below the value of its stuff, basically?
Right, okay. And ROE.
ROE, return on equity. This is net income divided by shareholder equity. It shows how efficiently the company uses the money shareholders invested to actually generate profits. A consistently high ROE. That suggests good management and a profitable business.
Okay, that helps a ton. So you look at those numbers, earnings, debt, ROE, find healthy companies. What kind of companies tend to be good candidates for holding long term?
Well, the sources often point towards industry leaders, blue chips. These are large, well-established companies. They have a proven track record, often a competitive advantage, sometimes called a moat, that protects them.
Like a castle moat.
Exactly.
Yeah.
Keeps competitors at bay. Think of companies like Apple, Microsoft, Johnson & Johnson. They've been around, they're generally stable, and they keep innovating or holding their market share.
And what about dividends? Do they matter for buy and hold?
They absolutely can. Companies with a long history of increasing their dividends, that signals financial stability and, frankly, a commitment to shareholders.
Like the dividend aristocrats.
Precisely. They show disciplined, consistent profits. And reinvesting those dividends right back into buying more shares, that just turbocharges the compounding effect we were talking about.
Okay, and diversification sounds crucial here too. Don't put all your eggs in one basket, even a blue chip one.
Oh, absolutely critical. The sources strongly advise diversifying, spreading your money across different companies, different industries. It just reduces your risk if one specific company or, sector hits a rough patch.
And an easy way to do that is?
Exchange-traded funds, or ETFs.
Right. What's an ETF again? Quickly.
An ETF is like a basket holding lots of investment stocks, maybe bonds. When you buy one share of an ETF, you're getting a tiny piece of everything inside.
Oh.
So buying an S&P 500 ETF like SPY instantly gives you a piece of 500 large U.S. companies. A total stock market ETF like VTI gives you even broader exposure. It's a really simple way to get instant diversification without picking hundreds of stocks yourself.
That makes a lot of sense. And sticking with buy and hold helps you avoid some expensive mistakes too, right? Fees and taxes.
It really does. Trading frequently means paying more brokerage fees. And taxes, if you hold a stock for less than a year and sell for a profit, you usually pay higher short-term capital gains taxes.
Ouch.
Yeah. Holding for over a year. That qualifies for lower long-term capital gains rates. Big difference.
And emotionally. I imagine it helps keep you steady when the market goes wild.
Oh, dramatically.
Yeah.
Market swings are just part of the deal. The buy and hold approach helps remove that temptation to panic sell when things dip or chase some hot stock when everyone's excited.
Yeah.
It takes discipline to stay invested, knowing that, historically, the long-term trend is up and markets recover.
And the examples of this paying off are pretty amazing.
They really show the power of just patience. Think about Warren Buffett and Coca-Cola. He started buying way back in 1988.
Wow, 88.
Yeah, that initial $1.6 billion investment. It grew to over $20 billion in value. Plus, he's received enormous amounts in dividends over all those years.
Incredible. And the tech stories.
Well, the sources point to examples like Amazon. If you'd put just $1,000 in their IPO back in '97,
Okay.
it would be worth over $2 million today. Or $1,000 in Apple back in 2003. Over $1.5 million now.
That's staggering.
Now, obviously, these are exceptional results. Past performance isn't a guarantee, but they vividly show what holding a great company through its growth can do over decades.
Wow, just letting time do the heavy lifting.
Yeah.
Amazing. So, okay, moving from growing value to actually generating income. Let's talk dividend investing. How does that strategy work?
Right. So dividend investing focuses specifically on buying shares of companies that regularly share a slice of their profits with shareholders. These payments are called dividends.
Usually paid out quarterly, right?
Typically, yes.
Right.
Quarterly is common.
Okay, so I buy the stock, and then I just get cash payments.
That's the basic idea. You buy dividend-paying stocks, you receive those regular dividend payments. And a really key part of the strategy, for wealth building anyway, is often reinvesting those dividends.
So use the cash to buy more shares.
Exactly. Buy more shares of that same company, or maybe other dividend payers. This process continues, growing your total number of shares and, consequently, your income stream over time.
Why is this seen as so powerful, particularly for long-term wealth?
Well, first off, it provides a stream of passive income. You get paid just for owning the stock.
Right. which is great for retirees, I imagine.
Very appealing, yeah. People nearing or in retirement often use that dividend income to help cover their living expenses,
Makes sense. And I bet compounding is huge here, too.
arguably even more powerful with dividends. When you reinvest those payments, you automatically buy more shares.
Uh-huh.
Those new shares then earn their own dividends, which buy even more shares. It creates this incredibly strong compounding snowball over decades. One example showed reinvesting dividends could actually more than double your total return compared to just taking the cash over, say, 30 years.
That difference is huge. And dividend stocks themselves, are they often seen as more stable?
Generally, yes. Companies that consistently pay dividends are usually, well-established, mature businesses. They tend to have reliable profits, strong cash flow,
Less volatile, maybe?
often less volatile than younger, high-growth companies, yeah. That adds a layer of stability to your portfolio, which can feel pretty good during uncertain economic times.
And the sources mentioned they can even outperform sometimes.
Yeah, studies cited in the materials suggest that, historically speaking, dividend-paying stocks as a group have outperformed non-dividend stocks over the long term. They can also hold up a bit better during market downturns because those dividend payments provide some return even if the stock price dips.
Okay, so what kind of dividend stocks should you be looking for based on the materials?
The sources outline a few types. Probably the most stable are the dividend aristocrats.
Heard that term before?
Yeah, these are companies that have increased their dividend payout every single year for at least 25 consecutive years. That's a long time.
Wow.
These are companies with very strong financials, real commitment to returning value. Examples include Coca-Cola, Procter & Gamble, Johnson & Johnson, McDonald's, names you know.
Okay. What if someone wants more income right now? Higher yield?
Then you might look at high-yield dividend stocks. These pay an above-average dividend yield, often 4% or more. Companies like, say, Verizon, AT&T, maybe Altria could fall here.
But there's a catch.
There can be. The sources caution that an exceptionally high yield, maybe 8% or more, can sometimes be a red flag. It might signal the company's in trouble and the dividend isn't sustainable. So higher yield often comes with higher risk. You need to check the company's health.
Right. Due diligence needed. What's the third type?
Dividend growth stocks.
Hmm.
Now, these might start with a lower yield, but the key is the company has a history and the financial strength to consistently increase that dividend payment year after year.
So the income grows over time.
Exactly. Think companies like Apple, Microsoft, Visa. The focus here is on the growth of your income stream over the long haul, which can become very powerful.
Any other categories for income generation?
Yes, real estate investment trusts, or REITs.
Rates, right.
These are companies that own or finance income-producing real estate. And the tax rules basically force them to pay out at least 90% of their taxable income as dividends.
Which means high yields, usually.
Often, yes. Examples mentioned were Realty Income, O, American Tire, AMT, Simon Property Group, SPG. It's a way to get real estate income without actually owning property yourself.
That's a great breakdown of the types. So if someone wants to start, what are the practical steps, according to the sources?
Okay, first step, identify potential dividend stocks. Use the criteria we talked about. Look for that history of increasing dividends. 20-plus years is a great sign. Check the payout ratio.
Payout ratio.
Yeah.
How do you know if it's sustainable?
Good question. The sources suggest looking for a payout ratio below, say, 60%. If a company's paying out much more than 60% of its earnings, it might not have enough left to reinvest in the business or handle problems. Makes the dividend less secure.
Makes sense.
Also, look for that consistent earnings growth and a strong balance sheet, just like with buy and hold.
Okay, find the companies. Then what?
You'll need a brokerage account. And importantly, choose one that makes it easy to set up dividend reinvestment plans, or DTRIPs.
DTRIPs. Okay, what do they do exactly?
A DTRIP automatically takes the cash dividend you receive and uses it to buy more shares, sometimes even fractional shares of that same stock, right in your account.
Ah, so it automates the reinvesting.
Exactly. It's key to maximizing that compounding effect over time without you having to manually do it. Platforms like Vanguard, Fidelity, Schwab, M1 Finance were mentioned as good options that support DRPs.
And just like buy and hold, this is a long-term game.
Absolutely essential. Dividend investing really shines over decades. You need to let time and that power of reinvested dividends build your position and your income. It's not about getting rich quick. It's about building wealth steadily, creating that growing income.
What are the specific risks to watch out for with dividend investing?
Well, the main one is a dividend cut or suspension. If a company hits serious financial trouble, they might reduce or even eliminate their dividend.
Which hurts your income and probably the stock price, too.
Usually hits the stock price hard. Yeah. And we mentioned those high-yield craps yields that look too good to be true might signal a company in distress, not a bargain.
And market risk still applies, even
Yeah.
to these stable payers.
Oh, yeah, they're still stocks. Their prices will go up and down with the overall market. They can lose value in a crash. But the idea is if you stay invested, you keep collecting that dividend income through the downturns, and you're positioned for the recovery.
Okay.
The material generally suggests sticking with those dividend aristocrats and dividend growth stocks might offer a potentially lower risk profile because of their proven track records.
So dividend investing sounds like a really powerful path for building wealth, getting that passive income, and adding some stability.
It's definitely presented as a solid approach, particularly good if you want income alongside growth potential, really powered by that compounding from reinvestment.
Okay, beyond these core strategies, the sources also briefly touched on two different philosophies for picking stocks: growth versus value investing. Can you quickly walk us through those?
Sure. So growth investing, that focuses on companies expected to have, well, rapid growth in revenue and earnings, much faster than the average company or industry.
So the goal is really the stock price going up appreciation, buying into that future potential.
Exactly. You're banking on capital gains. These companies are often in innovative, fast-expanding sectors. Think tech, biotech. Characteristics usually include really high revenue and earnings growth rates, maybe 20% or more per year was mentioned.
And they probably don't pay dividends.
Rarely.
Yeah.
They typically reinvest all their profits back into the business to fuel that super fast growth.
Which sounds like it comes with higher risk.
Generally, yes. Because so much of their stock value is based on future expectations, they can be quite volatile. If they miss growth targets or market sentiment shifts, the stock price can fall sharply.
Gotcha. Examples.
Examples mentioned were companies like Tesla, Amazon, NVIDIA, companies that have had incredible returns over the last decade or two, like thousands of percent, but definitely not without major ups and downs along the way.
Okay, so growth is about chasing that rapid expansion. What about value investing then?
Value investing is a different philosophy. It's focused on finding stocks that seem to be trading below their true or intrinsic value, looking for bargains in the market.
Like finding that dollar bill selling for 80 cents.
Precisely. The core idea is buy low, sell high, but applied systematically. Value investors look for companies with strong fundamentals, solid earnings, low debt, good cash flow, but where the stock price looks cheap based on metrics like a low PE ratio. They also often prioritize companies with that sustainable competitive edge, that moat, and it requires patience because it might take time for the market to realize the stock is undervalued and bid the price up.
And what kind of companies fit the value description?
The sources listed examples like Coca-Cola, JP Morgan, Procter & Gamble, Johnson & Johnson. You'll notice some overlap there with dividend stocks and blue chips.
Yeah, I see that.
Value investing often leads you towards more mature, stable businesses that might just be temporarily out of favor or overlooked.
So quite different characteristics. I remember the sources had a helpful comparison.
They did. The key differences they highlighted were things like stock type. Growth focuses on fast growers, often high PE. Value looks for undervalued, often low PE. Dividend focus. Growth stocks rarely pay dividends. Value stocks often do. Risk level. Growth is generally seen as higher risk, more volatile. Value, lower risk, more stable. Time horizon. Both are long-term, but growth often implies a very long horizon. 10 plus years, maybe. Value might pay off medium to long-term. Examples, we mentioned growth like Tesla, Amazon. Value like Coke, JP Morgan, P&G.
Fascinating how they target different company types and really appeal depending on your goals and your comfort with risk, I guess.
They offer distinct paths, yeah. And, many investors actually blend elements of both strategies in their portfolio.
Right. Now, we've covered a lot of potential and strategies, but it feels crucial to circle back to that initial fear of risk. How do the sources advise actually managing the risks involved in stock investing?
Yeah, the material's very clear. No investment is totally risk-free. Market risks like crashes, recessions, they will happen.
Right. Not if, but when.
Exactly. And the consistent advice across all these long-term strategies is to try and stay invested through those downturns. History shows markets recover, and staying in allows you to benefit from that recovery and the long-term growth.
So don't panic sell.
Try not to. And crucially, only invest money you're confident you won't need in the short term, say the next 5 years or even longer. Don't invest your emergency fund.
Okay, that makes sense. What about the risk of one specific company just failing?
That's company-specific risk.
Mm-hmm.
And yeah, even big, seemingly strong companies can decline or, go bankrupt. The sources mentioned cautionary tales like Kodak or Blockbuster.
Right, huge names that disappeared.
Exactly. They seemed dominant but didn't adapt. The key defense here is diversification, like we talked about. Don't put too much money into any single company. Spread it out across many different stocks, different industries, so if one company struggles, it doesn't wreck your whole portfolio.
And keep an eye on them.
Yeah, staying somewhat updated on the financial health of what you own is smart.
And what about bigger economic risks, like inflation hitting certain sectors harder?
Those are macroeconomic risks.
Hmm.
Yeah, broad economic conditions like inflation or recession can hurt certain industries more than others. The sources suggest maybe considering investments in sectors known to be more resilient.
Like what?
Things like healthcare, consumer staples, stuff people buy no matter what, like toothpaste or food. And maybe certain parts of technology were mentioned as examples that can sometimes hold up better against inflation, for instance.
So diversification isn't just about the number of stocks, but also the types of companies and industries. Okay,
Exactly.
it's about building a portfolio that's robust enough to handle different kinds of economic weather, you could say.
Okay, this deep dive has been incredibly helpful, really practical. We've sort of demystified how the stock market can be this powerful tool for building wealth, not through luck, but through knowledge, patience, and discipline.
And we've laid out some proven long-term strategies from the material. Buy and hold, focusing on quality and compounding, dividend investing, building that passive income and growth through reinvestment, and we explored the different angles of growth and value investing too.
So for you listening, you now have, hopefully, a much better foundation from this deep dive into the sources on how to approach stock market investing, using concrete strategies and that crucial long-term mindset.
Yeah.
Hopefully you feel a bit more empowered, maybe more confident, to look at the market not as this big, scary unknown, but as a place where you can actually steadily work towards your financial goals. That knowledge really is the first step to taking control. It's about building your financial future, brick by brick, letting time and smart decisions work for you.
So thinking about these different approaches we discussed, that steady climb of buy and hold, the income stream from dividend investing, the chase for rapid growth, or seeking out those value bargains, which of these really resonates most with your personal goals? Are you more focused on income now or maximizing potential growth down the road? And how might you even maybe combine elements from these strategies to build a portfolio that's truly unique to you and your vision for your financial future? Definitely something to think about as you plan your next steps.